Welcome to the deep dive. Today we're tackling something huge, something that affects, well, pretty much everyone in New Zealand and is watched closely overseas, the housing affordability crisis.
It really is a massive issue. And for this deep dive, we're working from this incredibly detailed report. It's packed with data, tracing everything from the 1980s right through to 2025.
Right, and our mission really is to follow that report's narrative. How did New Zealand go from, relatively affordable homes back in the 80s to having one of the most unaffordable markets in the OECD today?
It's quite a journey.
We'll dig into the timeline the report lays out, the causes it identifies, the policies they tried, what worked, what didn't, and what the report thinks might be coming next.
Yeah, it's a story of these compounding pressures over decades, all documented really meticulously in this material.
Okay, so let's jump in where the report starts. The 1980s. What did things look like back then?
Well, the report describes it as, stability before the storm. Median house prices were, get this, around $40,000 NZD.
40,000. Seriously. That feels like ancient history now.
It really puts the change into perspective, doesn't it? The report shows affordability was just completely different income. Median prices were about 3 times the median income.
Wow.
And home ownership was high, pretty stable, around 73%. Getting a mortgage, it typically took about 25% of your income. The whole financial system was more conservative too. Credit wasn't as easy to get.
And the report makes a point that even the big cities, Auckland, Wellington, places that are so expensive now, were actually affordable compared to incomes back then. That's a crucial baseline.
Absolutely. And what's interesting is how quickly the report shows that picture starting to shift as we head into the 90s.
Yes, the 1990s. The report really points to deregulation kicking things off.
Exactly. That's flagged as a key turning point. Financial deregulation in the late 80s, early 90s, it basically made credit much, much easier to access.
So the banks just started lending more freely.
Pretty much. The report says banks got way more aggressive with mortgage lending and that easy money. It fueled more interest in property investment. Land prices started climbing, especially, in Auckland.
And by the end of that decade, 1999, the median price, the report says, had already hit about $160,000, quadrupled already.
Yep. And that's where the report ends. We see the first kind of subtle dip in homeownership rates. It starts this long slide downwards, and affordability in the cities really began to weaken.
Okay, so the stage is set. Then the report calls the 2000s the boom years. What factors really lit the fuse then, according to the analysis?
It was like a perfect storm, the report suggests. You had low interest rates, making borrowing cheap. You had a big jump in immigration, pushing up demand, especially in cities.
Right.
And crucially, the report highlights this growing problem of not enough new houses being built, particularly in those urban centers. Plus, speculative investment really ramped up. Properties started looking like the best place to put your money.
And this is where prices really started to pull away from what people were earning?
Massively. The median house price just surged. It hit around $350,000 by 2007. The report specifically calls out Auckland and Queenstown. They became severely unaffordable during this time.
And debt levels.
Household debt-to-income ratios went up dramatically, and homeownership kept falling, dipping below 70%.
So the market was already pretty overheated leading into the late 2000s. What happened during the global financial crisis, that 2008-2012 period? Did that cool things off?
Well, the GFC did cause a bit of a dip in prices, the report shows, mostly outside Auckland, actually. The median price in 2010 was only slightly up from 2007, around $355,000.
Okay, a pause then.
Kind of. But the report notes the recovery was surprisingly fast. It was propped up by all the government stimulus globally, and critically, interest rates stayed low, which kept housing demand strong.
But hang on, the report says even though prices didn't jump much nationally then, affordability actually got worse. How does that work?
Yeah, that's a really important insight from the report, because house prices sort of leveled off or dipped slightly, then recovered, but incomes for a lot of people basically flatlined after the GFC.
Ah, right.
So the gap, between what people earned and what houses cost just kept getting wider.
Which sets us up for the next phase the report calls hyperinflation from 2013 to 2019. This sounds like where things went, well, really off the rails.
It's putting it mildly. This is when the national median price just soared, hitting around $675,000 by 2019.
Wow.
And the report makes a special point about Auckland. The median price there actually crossed the $1 million mark in the late 2010s.
Over $1 million for a median house. That's just staggering. What does the report say was driving that kind of explosive growth?
The report really focuses on supply problems during this period. Things like restrictive urban planning rules, especially single-dwelling zoning,
Hmm.
which made it hard to build more densely.
Right, limiting how many homes could actually be built.
Exactly. And a real lack of public housing being built, too. So you had this failure to build enough, especially in the cities, crashing right into continued strong demand.
And homeownership.
Hit a new low, according to the report. Dropped to about 64%, the lowest level since World War II.
Okay, so already at crisis levels, and
Okay.
then COVID hit, 2020, 2021, another massive surge.
Yeah, the report calls it historic growth. Median prices nationally jumped over 25% in 1 year, 2021. That pushed the national median up to around $925,000.
A quarter jump in a year, on top of everything else. What fueled that, according to the report?
A combination of things, really. You had ultra-low interest rates because of the pandemic response, government stimulus, some of which found its way into housing, and a huge dose of FOMO, fear of missing out.
Everyone rushing in thinking prices would just keep going up forever.
Exactly. Buyers, investors. The report has this stark statistic. In 2021, investors bought over 40% of all properties in Auckland.
40% investor purchases. That must have just blown affordability metrics out of the water.
Completely. The report shows affordability indexes hitting over 10 times median income in some cities during that period. 10 times income is widely seen as, severe crisis territory.
Which brings us, following the report's timeline, more or less up to date. 2025 in the report's analysis. What's the situation now after that absolutely crazy peak?
So the report indicates prices have cooled off a bit since that 2021 high. The national median in 2025 is noted as being around $780,000, so down about 15% from the peak.
Okay, some relief then.
Some, yes. Mortgage rates also peaked, the report says, around 6.5% in 2023, and they've eased a little by 2025.
But $780,000 is still vastly higher than just a few years ago. The underlying problem isn't gone.
Not at all. The report really stresses this. Affordability is still at crisis levels, still around 8 to 10 times median income in the main cities.
And for people trying to buy now.
It's incredibly tough. High mortgage payments are a massive hurdle. The report suggests they're often taking up over 40% of income for new buyers.
Ouch. And what about homeownership overall? And renters?
Homeownership is still hovering low, around 62%, the report notes. Still near those multi-decade lows. And for renters, yeah, prices have stayed high. The report talks about many being pushed into housing stress, spending more than 30% of your income just on rent.
Okay, so the picture in 2025, according to the report, is a market that's maybe stepped back from the absolute fever pitch, but it's still fundamentally unaffordable and causing huge financial strain for, well, a lot of people.
That sums it up pretty well.
So, given this whole journey, this long buildup, what does the report identify as the main underlying causes? What really drove this crisis?
The report breaks it down into a few key areas, all sort of interconnected. First, on the supply side, it points to these fundamental blockages.
Like what?
Things like limited land being made available for building, driven by restrictive zoning rules, especially in Auckland. High construction costs are also a big factor, and just decades of underinvestment in public housing stock.
Right, so basically, not enough homes getting built where people need them, and it's expensive to build them anyway. What about the demand side?
Well, the report points to sustained population growth, from immigration and natural increase. That keeps demand high. Then there are the low interest rates we talked about, particularly post-GFC. And during COVID, that just poured fuel on the fire by making borrowing easier.
Okay.
And the report specifically calls out the tax system. It argues that the way property investment is treated gives it advantages, making buying existing houses as an investment more attractive than, say, investing in businesses or building new homes.
That whole idea of property being treated more favorably than other investments, kind of encouraging speculation over supply. What about policy failures? Does the report point fingers there?
It does suggest policy played a significant role over the years. Things like slow planning approvals at the local council level, which held up development. Not enough investment in things like public transport to support building more densely in cities.
Right.
And significantly, the report notes the lack of a broad capital gains tax on most residential property sales. It suggests this acted like a missing brake on the market overheating.
And there was one other factor. The report mentioned this financialization of housing. What does that mean?
Yeah, that's this trend where housing gets treated more and more like a financial asset like stocks or bonds, rather than primarily as, a place to live.
Ah, okay.
The report links this to that surge we saw in investor demand, both from within New Zealand and overseas. Also just the general perception that property was the safest, best investment. And things like the rise of Airbnb reducing the long-term rental pool.
Okay, so it's this complex web the report describes. Supply held back, demand boosted by cheap money and investment incentives, policy perhaps not keeping up, and this shift towards housing as primarily an asset. Given all that, what major policies were tried, and what does the report say about how well they worked?
The report looks at several key ones. Kiwi Build is a big one, launched in 2017. It aimed for 100,000 affordable homes.
Ambitious goal.
Very. But the report notes it massively underdelivered fewer than 1,500 homes by 2025. So it's widely seen in the report as, well, a failure in terms of its original goals.
Okay, a big gap there. What about restricting foreign buyers? That happened in 2018, right?
Yes, the foreign buyer ban. The report acknowledges it did reduce some external pressure on demand. But the data in the report suggests it didn't really slow down the domestic speculation, which the report identifies as a larger driver of price growth during that period.
And the bright line test, making people pay tax on gains if they sell investment properties quickly.
Right. That was extended to 10 years for investment properties. The report suggests this probably discouraged short-term flipping, buying and selling really fast for profit.
Thanks, so.
But it hasn't really deterred investors who plan to hold on to properties for the longer term, which is still a big part of the market.
And more recently, there have been moves to allow more density in cities.
Yes, the report covers those urban density reforms from 2022-2024. In Auckland, Wellington, Christchurch mainly, allowing up to 3 homes per site in many areas without needing complex consents.
Is that showing any effect yet?
The report says early data indicates an uptick in building consents being issued. So it suggests this policy might be starting to help on the supply side, but it concludes it's still too early to judge the real impact on affordability itself.
Okay, promising but early days. And finally, the central bank's actions raising interest rates pretty sharply in 2022-23.
The report acknowledges that definitely helped cool down the rate of price growth, contributing to that pullback from the 2021 peak we discussed.
But there's always a but, isn't there?
Well, the critical point the report makes is that by pushing mortgage rates up so much, those hikes actually made affordability worse for people trying to buy now. Their repayment costs went way up.
Right. It slowed price rises, but made the entry cost, the monthly payment, even higher for new buyers. So the report seems to suggest a real mixed bag on policy outcomes. Some limited impact, some may be promising, others with tricky side effects.
That seems a fair summary of the report's assessment.
So looking ahead then, what does the report forecast for the next few years? And more importantly, what solutions does it actually propose to fix this long-running crisis?
In terms of forecasts, the report suggests pretty modest house price growth through to about 2027. It hints affordability might improve slightly, maybe, if wages manage to grow faster than house prices and if interest rates continue to ease back. But, and this is the crucial part of the report's outlook, the deep structural problems, the supply issues, the demand incentives, they're still there. They haven't gone away.
So just waiting for things to correct isn't the answer, according to this analysis. What solutions does it put on the table?
It argues for a pretty comprehensive, coordinated approach. First up, serious zoning reform, allowing much more density, more apartments, more townhouses, especially in the cities, basically making it easier to build up, not just out.
Increase the supply where people actually want to live. Makes sense.
Exactly. Second, it calls for national housing targets, but with better coordination between central government and local councils to actually make sure those targets get delivered.
So setting goals and making sure they happen on the ground.
Right. Third, a big expansion of public housing and also cooperative housing models, basically. More non-market, affordable options.
Okay, more government or community-led housing.
Fourth, the report suggests seriously considering things like a broad capital gains tax on residential property or other tax changes to kind of level the playing field and reduce the incentive for purely speculative investment.
Tackling that investment demand directly.
And fifth, stronger protections for renters and actively encouraging the build-to-rent sector, large-scale developments built specifically for long-term rental.
To provide more secure, stable rental housing, it really sounds like the report's conclusion is there's no single magic fix. It needs action on multiple fronts simultaneously.
That is precisely the takeaway from the report's summary. It frames the crisis as this result of decades of different things, compounding policy decisions, or lack thereof, runaway demand fueled by speculation, and just this systemic failure to build enough housing.
And the gap between incomes and house prices, the report says, remains one of the biggest in the developed world.
It does. And the report argues pretty strongly that fixing it requires more than just fiddling around the edges. It needs a fundamental shift.
A shift in how we think about housing.
Exactly. Rethinking housing, as the report puts it, not just as an asset class, something to build wealth with, but primarily as a social good, a fundamental human need. And that policy should prioritize ensuring people can access it.
Which really leads us to the final thought we wanted to leave you, the listener, with today, drawing directly from this report's conclusion. It suggests housing needs to be fundamentally rethought less as just an asset, more as a social good. What does that distinction actually mean in practice? For policy choices, for city planning, for how we live?
And perhaps the tougher question the report implicitly asks. In a society where so much wealth is tied up in property, how could a shift like that, a real change in perspective, even begin to happen? It's the core challenge the report leaves us grappling with.